Stephen Wood is the chief market strategist at Russell Investments, and he sees the S&P 500 climbing maybe 8.5 to 10% this year. Stephen, good to have you with us. 8.5 to 10%. That's not too shabby.
It's not too shabby. It's not too bad. It's more normalized rate. Actually, if you look at the long-term 80-year history of the S&P, it's a little bit below that.
You and your long-term.
Long-term.
All right, long-term 80-year history.
Put the odds of your back.
I get it. What are we talking? 80-year? What are we talking about? 80 years for what?
Well, if you look at long-term market returns, I mean, you want to take as broad a sweep as possible, so then you can kind of iron out the volatility of like the last 2 years, because you don't want to bite into those head fakes, you know. And when you look at it from a longer term perspective, there's plenty of reasons to get overly arrogant and confident, and there's plenty of reasons to get overly fearful. So you want to
like the last 10 years.
Yeah,
I mean, talk about fearful and despair, right? Yes. I mean, we're talking about 10% cumulative returns for the last 10 years. That's got to change people's mindset.
I think it does, and you've had the decade that didn't exist. You've just kind of taken the top off of that curve. The same is true in housing market, as now we've seen that's also true in equities, but it also depends on when you got in. You know, if you're a person in Phoenix or California, if you bought a house in 1992, I mean, life is still pretty good, even given the correction. So it depends on what you got and the entrance points.
You know, last time you were here, you said something that has stayed with me, which is, and many people have described this. So I'll give you the combination of intelligence with a lot of other people, which is that you lock in your profit when you actually begin the trade, or when you buy the house, or whenever it is, when you actually put the money down for whatever asset it is, not when you sell it.
Correct. So you lock in your profit at that purchase point. And that's why, you know, if you look into next year, or this current year, sorry, if we look in that 8.5 to 10%, I mean, this is going to be the function, though, of a lot of great research, a lot of due diligence, and a lot of tough yards. And we've already had, you know, maybe about a third of that, you know, in the first week. So you should expect choppiness. You shouldn't expect a robust bounce off of a bottom. I think it's going to be more difficult work than just being in the market. So what do you want to buy? What do you want to hold? And when are you getting into it? So we've seen the valuation story and the earnings story kind of play its way out. I think we're looking into an earnings growth and a revenue story.
And you like financials.
It's some financials. And we're looking from a global perspective, obviously. So take my comments to be from a global perspective.
Okay, right. Not just U.S. banks, not just U.S. non-bank financials.
But also, you know, within the U.S. and in the developed world, I mean, you've got the government backstopping a lot of the profitability. You've got the yield curve very attractively maintained by the Federal Reserve.
Come on. I mean, if you can't make money with a yield curve like this,
that's right,
you're not a bank.
So you've got a handful of basis points that you're getting money as a financial, and if you even roll into allegedly risk-free, you know, sovereign debt assets, I mean, you're still making a handsome return right there. So that's going to allow banks to repair their balance sheets, and they're going to inch their way into actually getting back into business, which is to lend money to private entities and really underwrite and understand that risk. So I think it depends on the name.
You mentioned that idea of alleged safety in sovereign debt. Should we be concerned? I mean, we know what's happened with Greece, a little bit, you know, with Ireland as well as in Spain. I mean, should people be concerned?
I think they should always be aware that there are risks to any investment. Now, for the United States, we have the benefit of being the reserve currency. We're the largest economy.
For how long?
Well, I think for the foreseeable future. And if we can just take an aside there, we've been talking about diversifying away from the dollar if you're the other countries. I mean, this has been going on for a generation. If it would have been so easy and feasible, it would have been done already. So that SDR approach, basket approach, it has limited
special drawing rights for people that don't know it. SDR, go ahead.
Yeah. So that has limited, I think, functional prospects. So the United States is still the reserve currency. 70-some% of international trade still is denominated.
You bearish or bullish on the dollar right now?
I think I'm kind of in the middle. I mean, you're ticking the boxes of currency that could weaken, but also ticking the boxes for reasons why it could be up. So I think the dollar.
We had that thing, right? Australian dollar 25-year high, the Aussie dollar against the U.S. dollar.
Correct, and that is also one of the areas that we're looking at Russell. That's more of a risk for people who are long Aussie dollar. So you might want to rethink that. Those trades don't
take some of those profits.
That's the new carry trade because we're the funding currency. So you might want to rethink that. But I think the dollar probably doesn't go a whole lot of anywhere for the next large number of months.